Well, joining us right now in the studio is two very special guests. Vikas Prasad, Portfolio Manager, Asia Equities at M&G Investments, and with him, Deepika Mundra, Director at M&G Investments. Vikas, Deepika, thank you both of you for taking the time out and joining in. So what has changed, Vikas, from the last trip that you guys were here? Was that in Feb, right? You said that India was the cheapest market. Do you still say that, looking at the screen?
Well, yes. So always a pleasure to be here. I'll just start by saying when we were here in February, one thing that we said is, if you look at the equity markets, you can't call India an emerging market anymore. It has emerged. How much more do you need it to emerge? It's here, one of the 3 or 4 largest markets in the world, 3 or 4 largest economies in the world, 6,000 listed companies, the busiest ECM market in the world. So that was my view then. Deepika and I have had 30, 35 meetings between us over the past 2 weeks that I've been here. I now remain convinced that for the next 5, 10, 15 years, it is the cheapest market in the world. You can look at a 1-year PE forward multiple on the market and say, well, this is very high in the context of the past. We'll look at China's multiple, look at Korea's multiple. And there are merits to those other markets as well. But you have to look at what the multiple becomes. And you have to look at the opportunity set here. A multiple doesn't define cheapness. It's the discount to intrinsic value. The intrinsic value of the Indian equity market is multiples of what it is today. So you do your homework, you bet right, you sit tight, and let time and the companies do the work for you.
But if one really looks at the way how the earnings trajectory is moving, last 2 or 3 quarters, we've hardly got any upgrades. It's been more downgrades, and the base effect has started kicking in. And given there where liquidity conditions are, what Reserve Bank of India is doing in trying to really, go after unsecured loans, don't you fear that in the near term there could be a case for earnings downgrade and the valuations could come under check?
Well, this is the benefit of being an active manager. We're not buying the market. We don't invest in the market. We invest in companies. And when you have a universe as large as this now, 6,000 listed companies, over $100 million market cap, the number's approaching 2,000 companies. And there's plenty of dispersion within sectors. So you do your homework. We find, if you look at our portfolio today, largely it's not changed very much from the start of the year. Less PSUs, less some of this, a little bit more of that. But our companies are benefiting from earnings upgrades, and they're benefiting from re-ratings still. So I think it depends where you're looking. There's still plenty of opportunities. We were in Gujarat last week. We met an industrial company trading on mid-teens earnings, 2 years out, leader in its space, gear maker. Earnings will accelerate. They should re-rate. And so we're happy to be in companies like that.
Deepika, you guys have met, what, 30, if not more companies in the last 2 weeks, right? Almost an India roadshow of yours. What's the collective India stack telling you? I mean, what have been your observations? Because pretty much you've, run through the entire span of the country.
Yeah. So some of the common things that we've picked up on this trip across meetings, one is, I think last time when we were here in February, also we highlighted some of the recovery plays, whether it's industrials, CapEx, commercial vehicles. We see some of those things still being largely intact. So just from which areas of the economy are growing, some of those recovery plays still are. So some of the cyclicals we still like, and that's reflected in the portfolio as well. The other things that I think common threads that we've picked up is premiumization. So we see a lot of demand for higher end consumption, whether it's hotels, airlines. India's largest airline after 17 years of operations is adding business class seats, right? Never happened before. Clearly they're seeing something different in terms of consumption patterns, and that's taking place. Luxury real estate being picked up pretty quickly. So premiumization, some of the cyclical recovery still, so construction and as well as engineering goods. And lastly, I would say Make in India. So we've heard of Make in India repeatedly again, but what we're seeing is a lot of self-help from companies trying to either improve productivity or looking at export markets, mining those markets. And some of it is policy, some of it is some trade barriers, but a lot of it is also global companies looking at diversification of supply chain. So I think from just hearing those things last year, this time we started to see some evidence of that coming through in terms of orders for either industrial component makers or for cables and wires companies. So these are the 3 things I would say that we've picked up.
The differentiating factor for India right now is the liquidity. Net DI plus domestic plus pension FI put together, it's about $6 to $7 billion on a monthly basis of net flows. Now, typically when that happens, the good ideas, they get mispriced. Is that the fear in India that earnings will grow, but It is like saying gold is now available at the price of diamond, or gold is still available at the price of diamond. How would you assess it?
I think we can share a combination of thoughts over here. But like Vikas said earlier, right, we're not investing in the full market. So yes, the job is harder. And as active managers, the point is to figure out companies within the same sectors which are doing well, but then concentrate your bets. And I think that is something which is very evident, whether you look at autos, IT services, financials. The last 12 to 18 months, just within the sector, there has been so much dispersion of stock performance. And that's, I think you have to do a lot more work today than what you would have thought just as a India, just buy India, essentially. So whether gold is available at the price of diamonds, in certain cases, yes, there are a lot of companies which are available at 70, 80, 100 PE. And while we don't want to focus just on the 1 year forward PE, some of these companies, it looks very difficult that they will materially outperform the market. So from a relative basis, yes, some of those stocks are difficult to play at the moment. But if you look wider, I think it's possible.
I actually think we're buying a lot of Sona at Chandi ke bhao in the market today.
Give me an example.
Well, some of the private sector banks that had underperformed, but also in the small and mid-cap space. I mentioned this gear maker that we have. When we added to the air conditioner supply chain, one of the makers there. Still, if you look at the long term, we met some of the power companies in Gujarat and in Delhi last week. And less than data centers, they were talking about air conditioner related power demand and the infrastructure required for that. India's air conditioner penetration is less than 10%. Whether it's 6 or 8 doesn't matter. It's headed towards 20, 30, 40, 50. So when you think about the affordability that brings, the power infrastructure that needs, you look at that entire supply chain. We've met companies in the T&D space also, transmission, distribution, less on the generation side. That whole supply chain, for the long term, this opportunity is going to be around for a very long time.
But, you know, like Deepika was saying, that the job is more and more difficult right now. It's a well-discovered market. You know that you are paying, what did you say, Sona Chandi ke bhao. But yeah, closing in at least on the Sone ke bhao, which are also at an all-time high.
Yeah.
So how do you make that distinction on whether to add to the, existing positions or, buy stocks of a fresh company?
So this is one of my favorite questions. I'll say 2 things about the portfolio. Number one, if you look over the last 2 years, one thing that has really helped us is we have been fully deployed. Cash in the portfolio has been 0 for 2 years. And part of it, we see that as our job and as our responsibility, but we have seen ideas. So there's been no cash drag on the portfolio, we've been fully deployed. Second, the way we look at it is if we think something is interesting and it starts to rally, we ask ourselves the question, honestly, if we already owned it, and would we sell it here? If the answer is no, then it's the exact same thing as buying. The converse is also true. Let's say something has a earnings miss, management change, strategy fails, stock falls, and if it's falling, if we wouldn't buy it at that price, then we should be getting out. So that's how we think about it. So that helps us keep us fully deployed. It lets us hold on to stocks for the long term. And because also the sizes of the positions have grown such that we can't be in and out of names. And so that also helps us stay in names. Actually, I'll add a third point. If you look at the portfolio today compared to 2 years ago, we had a lot of small positions that we thought we were wary that these names are small in the benchmark, but if we're 0 weight, they could go up 2, 3, 4, 5x. Now that the market is up as much as it is, we have fewer small positions because from here we feel that some of those multipliers are less likely to happen. If you look at one of the leading retail companies, just yesterday, a brokerage upgraded it to a buy after it's gone from about 10 basis points in the benchmark to 100 in the last year. The stock is up 6x, right? I don't see many of their stores, but we feel that the probability that something like that could hurt us is less here. So we have fewer names in the portfolio now. Still no cash, fewer names, holding on to things for the long term.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits, and then break right through them. Become something more. It's my time to rise.